My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to this West Coast edition of Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. At the end of a week that was totally defined by the Fed, we finally got a respite from the Fed chatter today. Even when it's positive, there's only so much I can handle before I need a break. Without the interest speculation, the averages took a breather too. With the Dow advancing 38 points, S&P dipping 0.19%, NASDAQ declining 0.36%. But going forward, we're still very much in the hands of the Federal Reserve. When Fed officials talk, the market's going to listen. And it should listen. I've just been through these cycles so many times that I wish they left all the public communication to Jay Powell. Sometimes it feels like the Federal Market Committee is a little too small D, so to speak, okay? That means Democratic. I'm not saying Chairman Powell should take a page from Chairman Mao. But when it comes to free speech for regional Fed presidents, maybe they should just keep their mouths shut. All right, we got a lot of stuff here in mind for the next week's game plan because you'll quickly see what I mean. On Monday, the Fed speakers resume their dominance over the stock market media cycle, even as we'll wish they didn't once we parse the words of Raphael Bostic, the president of the Atlanta Fed, Austin Goolsbee, the president of the Chicago Fed. They'll explain why the Fed blessed us with a 50 basis point double rate cut, not the mere 25 basis points that most of us were expecting until last week. You know me, I think this whole game is a sideshow. It's a sideshow that freezes you from buying the stocks of terrific companies when their stocks are down. Of course, the main event on Monday will be the initial tally of how many iPhone 16s Apple managed to sell over the weekend. I know this is a tawdry game where invariably we're given more reasons to sell the stock of Apple than buy it. All I can say is that's how nearly all these iPhone launches have played out, both the good and the bad. So please, don't let this interim data sucker you out of your position. Again, own Apple, don't trade it. We're also going to hear more about this possible acquisition of Intel by Qualcomm. Now, this would be an odd couple, as Qualcomm historically hasn't liked the foundry business, and Intel is all in foundries. Maybe that's why Intel is trying to separate out foundries from the pastiche of businesses it owns in the last financial statements I saw. I don't know. We'll certainly learn more. But I've got to tell you, let's just say suspicious. How about that? The most intractable part of the now waning inflationary economy is housing. We lost two different streams of home sales in the last few years. The stream of people who want to move up but can't because they'll lose that low-rate mortgage, and the stream of new homes, which has slowed to a trickle because home builders are reluctant to build anything when rates are so high. I don't blame them. On Tuesday, though, KB Homes reports, and I hope they'll help us understand where we are in the housing cycle, because now that the Fed's cutting rates, you better believe that KB's 2025 should be a heck of a lot better than 2024. Mortgage rates down, more sales. Tuesday's also the day where HP Inc. shows some big institutions how their products line-up's being re-engineered by AI. In that sense, I've seen the future myself because we went to HP headquarters today. We're going to give you a sneak peek preview. You're not going to believe what you're going to see. It's tough to get a handle on small business. You can dial up payroll numbers from Paychecks. We like those. But you can also listen to the quarterly conference call from a company called Cintas on Wednesday, which delivers all sorts of things to the regular workplace, including uniforms. The stock's been remarkable, both because we've had surprisingly strong small business formation over the past 5 years, yes, even during COVID, and also probably because they keep taking share. Cintas does it better than anyone else. They're pure joy when they come on the show. After the close, we're going to test out a theory of mine about Micron. This company makes all sorts of basic memory chips going into everything. Also has high bandwidth chips that are used in data centers. But its stock has been crushed lately. In fact, it's been annihilated to the point where it might actually be a buy, no matter what the critics have to say about the quarter. I am looking for balance, even as this market has gotten incredibly overbought. Thursday's pretty straightforward. Costco, core charitable trust holding, reports, and they're going to give us an update on what's selling and what isn't. The stock itself has been amazing. I think it continues to be amazing, which is why I've been telling the CNBC Investing Club, hold on. As much as I want to take a break from the Fed talk, Friday won't provide that because we get the inflation data that the Fed supposedly relies on the most. The series of numbers patched together, including the personal consumption expenditures indices. They'll trigger a whole new guessing game about how many rate cuts we're going to get this fall and by how much. And that is if we get any additional rate cuts at all. I've got to tell you, again, I don't think anybody knows. Just focus on good companies and good stocks, and you won't go wrong. Here's the bottom line. No matter what happens next week, I want to remind you that we're in a late we're in a rate cut cycle now. Okay, it's very different from the last couple of years. So the backdrop is now friendly. Don't treat it with hostility, please, even if it is overbought by any means. When the Fed wants to be your friend, the best way to try to make money is embracing the Fed's friendship. Let's take calls. Let's go to Miles in Louisiana. Miles.
Jim, got the Birds coming to town this weekend. That Superdome's going to be rocking.
I think that my team right now is I'm from Philadelphia, so I'll support my team. Let's leave it at that. What's going on?
Yes, sir. Just want to get your thoughts on Chevron. With rates coming down, the dollar presumably getting weaker, and a potential Harris administration with less oil coming on the market. What do you think about Chevron?
I think that the oils are a tough place to be. The fact that oil prices haven't gone up, even though there's so many shorts in oil, has surprised me. You're not going to go wrong owning a stock that says a 4.5% yield that buys back a lot of stock with Chevron. But be prepared. I don't think it's going to be the rocket that it was when it first went from, say, 100 all the way up to 171. I don't see that happening again. Anyway, I want you to remember that we're now in a rate-cutting cycle. So the backdrop for this market is friendly. Please don't treat it with hostility. You're going to miss a lot of opportunities if you do. Oh, man, Money Tony, how is AI powering up a new wave of PCs? I'm learning more with HP CEO ahead of the company's innovation-focused event next week. Then, after soaring on earnings, is RH sitting on a strong foundation, maybe even a gold mine? I'm talking to the top brass to see if this home-centric retailer can keep building higher. Plus, don't miss my check-in with the CEO of Okta. That could be a coil spring. We got to hear about what they have to say about cybersecurity and identity, of which they are the dominant player. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com. From a humble garage came a game-changing idea. After decades, the world has changed. But will a new partnership help take this icon's image into the future?
What's next for HP Inc., the old Hewlett-Packard PC and printing business, now that we're in the first inning of a new product cycle with a wave of AI-powered personal computers hitting the market? When HP reported late last month, it delivered what I would regard as maybe a mixed set of numbers, with PCs selling very well on the commercial side, but not so well on the consumer side. Could that change now that the Fed's trying to breathe new life into the economy with rate cuts, and there's a lot of new products coming for individuals? While we're out here in the Bay Area, we took the opportunity to sit down with Enrique Lores, the president and CEO of HP Inc. Take a look. Enrique, thank you first for having me. It's quite beautiful and insightful every time I come here.
No, Jim, really thank you for coming to our home. It was great to be able to show you the innovation we're going to be bringing to market in the next years.
All right, so let's talk about that. I've got a perfectly good 3-year-old, I call it a COVID PC, all right? It has everything that I think I need, but are there other things that I don't know I need, and therefore I should upgrade?
I think you should upgrade as soon as you can.
Okay, tell me why.
I think really with the introduction of AI PCs, we are going to be able to really have a very big impact in both the productivity and the satisfaction employees will be having with their work. They will be able to do things that today they don't even dream are possible, that will increase their productivity, increase their security, and actually make it even cheaper for the companies for them to work.
Okay, so Enrique, I've got to tell you, people are getting jaded. They hear AI PC and they think, well, why do I need an AI PC? I can just go to Gemini, I can go to ChatGPT. It's already on my current PC. Why do I need to go and spend more money to be able to do the same thing?
I think there are 3 key drivers of the value proposition of AI PCs. First of all, running AI is much faster, and you can do things in your local PC at a much faster pace than if you do it in the cloud. Second is significantly lower cost because you don't need to pay all the fees that you have to pay to use AI at the cloud. And second is more secure. You can use your local data to run your models, and therefore don't be concerned about uploading confidential information to the cloud. And we have many applications that display that, from product managers that can run their research on local data and use very confidential information locally, to product managers, and these were the examples we were giving you, that will be able to create concepts in a much faster way than what they can do if they run it in the cloud. Or, as we showed you, real-time translation that will help them to connect with people in other countries without having to wait for the translations to be done. Many, many applications that will continue to grow as software developers realize of how important these improvements are going to be.
Okay, so people are telling me don't get the one now because if I wait 3 months, it'll be even better. That would mean that next 3 months I would then wait for another. What is the jumping off point where you just think it's worth it to get it now for most people, considering all the uses that you know they do?
I think there is no reason why customers should not upgrade, but we also understand that sometimes they need to go through an evaluation process, make sure the new PCs work in their applications, and this is why we think the penetration is going to be gradual. But if you ask me why a year from now, 2 years from now, someone should buy a PC that is not an AI PC, I cannot answer that question.
Well,
everybody should be upgrading.
Now, I have terrible handwriting. Can it recognize my terrible handwriting and understand and have the data on me and then summarize what I'm writing? Because that's one of my biggest problems. I always have to take notes, and I always then look back and the notes aren't legible.
How you interact with computers is going to radically change. We cannot only understand your bad handwriting and make it digital and translate it to text, something much more difficult. It can understand my very poor English accent and translate that into words, into text, to make me much more understandable. So it's not only your handwriting that is a problem, Jim.
All right, so I would imagine this costs a dramatic amount more money than what I paid here.
It is not. Our estimate is the increase in average selling price is going to be between 10 and 20%. And this is why when we talk about why people will not upgrade once the application has been validated, there are not many reasons why someone should not do it.
Okay, now, because this is an older PC, my battery lasts for about an hour and 15 minutes. I'm in constant fear. I even carry one of those second batteries. I can click onto it. What would my new one have?
Actually, for us, sustainability is really important. And we think it's critical that we design products that will not end up in landfills. Right. And we are designing our products with upgradability in mind. And for example, for batteries, the next generation of PCs will be user replaceable. You will be able to replace your battery, and we will make sure that as you replace that, we get it back so we can recycle. Because it's not only making your life easier, what we care, it's about making sure we don't have a bad impact on the environment.
Okay, now we're looking at, obviously at the personal. If I were at the commercial, would there be enough that it would be time for most enterprises to upgrade what they have?
I think it's similar. In fact, I believe that contrary to what has happened in the last 10 years, where innovation started in the consumer side and went to the commercial side, the impact of AI PCs is going to be bigger on the commercial side because of the productivity improvement. And once the adoption in commercial will grow, the impact will go to consumer. Is the reverse of what we have seen happening in technology during the last 10, 15 years.
Are you happy with the pace of people getting new ones and the PC recovery? You have told me that we will eventually get it when it's just so dynamic that people will say, I've got to have it. Are we almost there? Are we there? What is the state of sales for PCs?
We have just started to release the new AI PCs. We did the first launch in July. We are launching the new family now in the fall, and we will continue to do that in the coming months. So I think the important thing is we are just at the beginning of a very deep transformation, and it is only starting. And today we see the improvements that these products can bring from a productivity perspective. We cannot even imagine the impact they will have a year from now, 2 years from now, 3 years from now, when more applications will be developed.
All right, one last question. If I were to go to my Best Buy where I get things, would they have any of the things that I just saw today or that will be imagined next week?
What you saw today is already available in the market. The applications that we were showing are available. We have a big innovation event next week when we are going to be inviting both developers and press and analysts to show what the new technology is going to be possible. And we will be showing what you showed you and many more things, because we are really at the edge of a lot of innovation that is going to be coming to our space, which is why you saw everybody here at HP is so excited. The opportunities that we have are endless, and we really think we're going to continue to transform and to define the future of work.
Well, what I saw today was that the AI PC is different from what I thought, more useful, and would make me far more productive. So I want to thank you, Enrique Lores, HP President and CEO, for once again redefining how we do our work and our play.
Thank you, Jim.
Coming up, give your portfolio a new design? Cramer catches up with RH next. A grand design to spruce up your home and renovate your portfolio? Furnishing profits and letting investors in on high-end trends. Is RH the stock to give your portfolio a classy edge?
Oh, it's been a fabulous couple of weeks for RH, the luxury home furnishings brand. I have to mention this, formerly known as Restoration Hardware. Soon I won't say that. Last week, the company reported a magnificent quarter. This sent its stock up more than 25%. These guys spent years investing heavily in the business correctly, preparing for the moment when the Fed would cut interest rates, kick everything, housing into overdrive, which we've been waiting for. So the double rate cut on Wednesday was actually huge for RH. And remember, the business was already picking up before the Fed did this thing. But don't take it from me. We have a treat. Let's check in with Gary Friedman. He's the visionary chairman and CEO of RH. You better read of the situation. Gary, first of all, I want to congratulate you. You kept spending during the downturn, so when it turned up, you had the right merchandise and therefore the right profits. And it looks like, as you say, the vector size, the margins, everything's inflecting in the right direction for you.
Well, Jim, we say, look, there's no big rewards without big bets. And we like to think deeply about making a few big moves. We've been working on this product transformation and platform expansion unveiling, and it's been a big investment. We also bought $2.2 billion worth of our stock back. We wouldn't do that unless we had a lot of confidence about what was coming. And while we can't control the interest rates or the housing market, it is a good sign to see a beginning of the easing.
Now, you've been calling this the most challenging housing market in 3 decades, and yet you still bought back a lot of stock. Is that a bet on Gary and his team?
Well, we only bet on ourselves, so we don't really make investments anywhere else. But we don't make investments of that size without a lot of thought or a lot of confidence. And history would prove. I mean, let's see, we just bought back 35% of the outstanding shares this time. In 2017, we bought back, I think, $1 billion something of our stock. And, since 2017, we bought back $3.75 billion of our stock.
Incredible.
And, history would prove that we're generally directionally right, when we make bets of that size. And so are we excited? We couldn't be more excited.
Well, that month of August was terrific, and I have to believe that September is continuing to be great.
Yeah. No, well, we've said that our business accelerated throughout the second quarter, ending July with up 10%, accelerated into the third quarter with August up 12%, and we expect it to continue to inflect positive throughout this year and into next year.
Now, you've got a lot of things that I find hard to describe. For instance, I can't call you stores. I don't think I can call you galleries. If you have a 90,000 square foot property in Newport Beach overlooking the ocean with bars, 2 bars, and I said to myself, what is it? How do I analogize? And the answer is, what's so great? There is none, is there?
Well, we say you have to think until it hurts, until you can see what others can't see, so you can do what others can't do. And if you want to be the best in the world, you can't be a follower. You have to be a leader. And that's sometimes a little confounding to people, especially if you're in the public market, because people, tend to like duplication or not innovation. But you have to, if you want to lead, you have to innovate and you have to take risks. But again, history would prove, all of these bets and all of these galleries that we've done are highly incremental and highly profitable. So it comes from really deep thinking and not, any kind of, quick decision making. We've been at this. I've been here as a CEO for 24 years. Right. So it's, we're not making this up. It's a lot of data, a lot of deep thinking, connecting a lot of dots, and be willing to place a few big bets that can change everything.
Well, I think that the data is something that really infuses you. I'll give you an example. I've been to Raleigh. I would not have thought that it would sustain a 50,000 square foot RH. But you've got data. Now, you know that there are cities like Raleigh that we, say in New York, are so parochial, we wouldn't know. That can be a tremendous store, can't it?
Well, we're already there. I mean, that's the good news. Almost every market that we're opening, these larger, more immersive, inspiring galleries, we have the data on almost every market. I mean, I think one of the first ones we're doing, we don't have data, is Montreal, but we know Canada. We're in Vancouver, we're in Toronto, and so on and so forth. So we have data. We've been at this a long time. And it's about understanding the math, connecting the dots, conceptualizing new and bigger and better versions of ourselves. And somewhere like Raleigh, I mean, we know the volume we do in Raleigh. We know when we open up a new gallery what the lift is. We know when we open a restaurant in a market like Raleigh, what's the restaurant volume we do. We know what the incremental traffic that the restaurant drives is also going to drive incremental revenue in the gallery. So, and all of that's, it takes time. We opened our first restaurant in 2015. We have 22 restaurants today. So we have a real restaurant platform, too, that creates traffic and, consumer awareness.
Now, Europe really gets you instantly, don't they? Every place you open, I know London's a little further than you thought, but when you open, people, do they know it's American? Do they understand? Because it doesn't seem to be what we think of as what we make. You appeal to, I'd say, a well-off group everywhere, but also to their artistry, to the belief that Picasso was right. You got to destroy it to make, and it works in Europe almost perfectly.
Yeah, well, look, Europe, like any new market, new country, do we have some brand recognition there amongst designers and certain customers? Of course we do, but it's going to take time for Europe to scale and become known the way it's known in America. And I tell everybody that the time to really focus on Europe is when we open London, Paris, and Milan. Those are the three key cities to build the brand. And we open Paris next spring. We open London in the late fall, and we open Milan in 26.
Wow, that's a big rollout.
Yeah, and those all have, those are meaningful galleries, integrated restaurants, wine bars, the whole experience. And so we haven't opened that yet. When we opened in the English countryside, 17th century estate, 73 acres, but we said, look, that was more for conversation than commerce. Right. And we wanted to make an impression, an inspiring and unforgettable first impression in Europe, as I think we did. But we're going to know a lot more over the next 18 months.
Well, now, are you concerned about tariffs and what it will mean for a person who's on the edge and trying to figure out whether they should reach for RH, of which, by the way, I know this is hard for people who are not regular shoppers of RH, but you're actually reasonable for the incredibly beautiful stuff that you make. You're not outrageous, but tariffs can make you be outrageous.
I don't know if tariffs, are an obstacle that are that difficult to overcome. Supply chases demand. We're really good at creating demand.
Right.
Supply, will move to appropriate places and countries. When the tariffs went up, we moved a significant part of our upholstery business, sofas and sectionals and things, back to America. We're now the biggest importer of Italian sofas in America, and we have our own factory in North Carolina making sofas. And so you have to be flexible. You have to be fast. There's always going to be obstacles like that. They're going to be obstacles for everybody. And so you just have to be faster, smarter, more creative, and taking lemons and turning them into lemonade. Right. Yeah.
Now, Gary, you don't do it the way others do, which is why we love you, frankly. And one of the things that I thought you pointed out was that you have a great take on society. For instance, you said that why do people pay a bunch of strangers, influencers, to say they love your brand on TikTok? I mean, we all are phony. Something happened. What happened to make it so that absurd things like that actually have some cogency?
Look, we're in a world. There's an explosion of social media. There's the digital visualization and connectivity is real. But the great brands that stand the test of time, they earn it, right? And they tell the truth. And having fake fans and people you pay to talk about you on Instagram or TikTok or whatnot, it's not the truth. Like, we don't have a marketing department. We have a truth group in our company. And I tell everybody, like, look, if people aren't talking about us, if people aren't interested in our brand, don't go pay them to talk about us. Let's do better work. Let's do inspiring work and let the world talk about us. So we don't have an Instagram account. We don't have a Pinterest account. We're, not on TikTok or any of these yet. We're the most Instagram brand of our kind in the world. We're the most pinned brand of our kind in the world because we're doing work that other people are talking about. So the key is where do you want to focus your time and your money? I don't want to sit here and think about what pictures are we going to put up on Instagram next week. Let's talk about the product. Let's talk about the platform. Let's talk about creating authentic connections with consumers, and let's just tell the truth. Okay, let's not let somebody else that we don't really know make things up. Somebody who's talking about 100 brands being paid to, get up there and unbox something, for God's sake. I mean, it's a different world. And again, you can't be a leader if you follow the crowd. You have to, you have to take the path, the road less traveled, and you have to define your brand your way, and not try to let somebody who's trying to define hundreds of brands also define yours.
Well, you're the only one I know doing that, but let me ask you a final question. What happens to people who underestimate the power of a few good people who don't know what can't be done?
There's something about persistence and passion and deep belief in what you do that is sometimes not understand. It's tough to understand from other people who maybe don't have something like that they feel that deeply about. I mean, we say, a lot of people say, oh, you're a lifestyle brand. I say, look, I don't even know what a lifestyle brand means, but we are a love style brand. We do what we love with people that we love for people that love what we do. It's that simple. And we're passionate about it. We will move mountains. We will march through hell for a heavenly cause in our organization. And it takes that kind of effort, and it's sometimes not understood. And if you want to do really great work, it's not work that somebody else has done. So you have to believe what hasn't been done. And you never want to bet against those kind of people. You're usually going to be wrong.
I like that.
Yeah.
I like that. That's Gary Friedman. He's the chairman and CEO of RH. They've inflected. The numbers are getting better and better, and Mad Money's back after the break.
Coming up, Cramer's West Coast trip continues with a longtime favorite. Keep it here for a high-octane sit-down. Next.
Last night, CrowdStrike CEO George Kurtz told us the cybersecurity solutions are still in high demand. But is that true across the whole industry, or are the larger players simply taking share from some of the smaller ones? Later this month, Okta, one of the leaders in identity verification, put a solid set of results, but gave what some people thought were a cautious quarterly guidance for its current remaining performance obligation. That's a technical term, basically the subscription backlog they expect to recognize over the next 12 months. Even though everybody else thought the guidance was fine, the stock plunged nearly 18% the next day, totally mystifying to me, and the stock still hasn't recovered. Also mystifying. So could this be a buying opportunity, or is there something I'm missing? Let's dig in with Todd McKinnon. He's the co-founder, chairman, CEO of Okta. To learn more, Mr. McKinnon, welcome back to Mad Money.
Thanks for having me. It's great to be here.
Okay, so Todd, I've got to tell you that there's been this kind of evolution going on with companies in your industry where they were using one metric, one benchmark, and that was reliable for a long time to prove growth. And it seems to have failed us. And it failed us for CrowdStrike. It failed us for Palo Alto Networks. It didn't show the true strength. Is it that metric failing to show Okta's true strength?
Well, particularly over the long term, the trends are very consistent and very bold and bullish over the long term. If you look at security issues and breaches, 80% of them involve some kind of compromised identity. So for a company to really shore up its security posture, they have to shore up their identity posture. And what we do is we provide identity technology, from the core access management for employees to the strong authentication for employees to customer identity. We can impact cybersecurity outcomes. We can impact revenue. We can cut costs. So long term, it's a very bullish outlook. I think the issue, or what everyone's working through, is what that means over the near term.
Okay, but what does it say that some companies are saying you really can't do these piecemeal anymore? You can't just put an identity vendor in with another kind of vendor. It's better to have a soup to nuts. What's the response to someone who says that's how I want to be?
Well, I think customers, they can't have one vendor do everything. Even a medium-sized company is going to have thousands of vendors across technology. So the challenge for customers is, what are you going to center on? Are you going to center on one vendor for collaboration, one vendor for CRM, one vendor for security? And our position in the market is our customers standardize on one vendor for identity. So workforce identity, customer identity, all the security aspects of identity. And that is the right choice, because it not only solves your security problems, but it also gives you choice in technology. You can choose the network security. You can choose the endpoint security. You can choose the applications. You can choose what kind of customer-facing solutions you want to employ. It doesn't lock you into a certain suite or a certain stack. Identity frees you up to enables you to use any technology that's best for you.
Well, I know you are, I don't want to say bare knuckles, but I know you're very adamant about this. I mean, for instance, in your most recent deck, you have a page that says Okta's superior choice versus Microsoft every time. George Kurtz just had this kind of go back and forth with Microsoft. They ended up joining forces, so to speak, because he just found that they were worth dealing with. You also joined forces. This is not the end. You're not out there in a zero-sum game against Microsoft, correct?
Well, Microsoft's view of the world is that they want to sell you everything.
Right.
They want to sell you the cloud platform. They want to sell you the collaboration tools. They want to sell you the applications.
And don't they also make it worth your while by bundling things, give you things that are a little less money?
They can, but there's a trade-off, Jim. I mean, there's no such thing as a free lunch. Everything comes with a cost. And in that case, if you buy identity and security all bundled in one solution, you're going to forego the choice to choose other things. And it might be for your company that a better security posture would be to use CrowdStrike and to use Zoom to collaborate and to use AWS for your cloud infrastructure. But they know that if they sweeten the deal a little bit with identity, they're going to make it back in many-fold over by foreclosing choice on customers. And we have a very different view of the world. We believe that identity is choice, and customers need to and will make the right choice to free them to use any technology over the long term.
Now, you did have a problem with your own internal systems being compromised, but it was a year ago. To me, when I look at the numbers, that is something that you put past, and it doesn't seem to be it's a part of the conversation anymore when you're making your propositions.
First of all, we've invested a ton of time and focus on not only shoring up our internal corporate infrastructure and making sure that we're one of the most secure companies in the world. We've also poured tremendous resources into making sure our products are secure by default, making sure we're leading the industry on setting design standards and implementation standards on how identity can be implemented securely. We call it our Okta Secure Identity Commitment. It's really our long-term commitment to fight against identity-based attacks. And that's resonating very positively with the market and with customers. I think when people look at the near-term outlook with Okta on the financial side, we are being conservative about, particularly the next quarter, to make sure that there's no impact of that, the breach from last October. And I think once we get past that year anniversary, we're going to take that, maybe some of that conservatism out of the outlook, and it'll benefit everyone.
Excellent. I'm glad to hear that. One last question. What is your advice to large institutions, enterprises, about what they should tell their workers? Because we all want to be, we don't want to be hacked. But sometimes I feel our companies don't tell us the best way to protect ourselves and therefore to protect the institution.
From a workforce security perspective, we have the tools, and we have for example, phishing. A lot of companies try to prevent phishing attacks against their employees by training them.
Yes.
Telling them not to click on links and not to fall for phishing. That is you can take that approach, but a better approach is to actually deploy phishing-resistant authentication. And you can do that with Okta. So you can't be phished if you have Okta deployed in phishing-resistant mode. So in that case, caution and knowledge is always good, but at some point we have to deploy the right technology to defend against the breaches, and we have the technology to do that.
I think you're right, because the bad guys are so sophisticated now that we will make the mistake, but your software won't, and that's what matters. I want to thank Todd McKinney, the CEO of Okta, with a conservative approach, as we heard, but the superior product. Mad Money's back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. It's time for the lightning round. Chris Ramirez, Brock Rolls, the same name as Talk. Buy, sells, just to go to the caller stock questions ahead of time. My staff prepares the graphics on the fly. You play the sound. And then the lightning round is over. Are you ready, Ski? Time for the lightning round. Chris, let's go to Ross in California. Ross.
Booyah, Jimmy Chill.
What's happening?
My question for you, with all the talk of data centers and the need for energy, it appears that the largest concentration of data centers is in Northern Virginia. What do you think about Dominion Energy?
I think Dominion Energy is a buy. I think it's out 4.6% yield, and you're absolutely right. We need cheap power. Everyone's buying all the companies that are related to nuclear. Sometimes you have to stick with the tried and true. Dominion's fine. How about Austin in Oklahoma? Austin.
Hey, Jim, how's it going?
I'm doing well. How about you, Austin?
Oh, not too bad, man. I was calling to ask you about a coffee company. And it's not Starbucks. I'm here to talk about Dutch Bros, BROS.
I like Dutch Bros. I'm glad that they slowed their expansion. It was kind of willy-nilly. I hate to see that. That's something that the bankers often talk you into. And I'm feeling it's much on steadier ground now as Christine Brown running the joint. Let's go to Larry in North Carolina. Larry.
Hi.
Hi.
Jim, I'm concerned about Supermicro computers. They've had some misconduct. What do you think of them?
You know what? I need to see the financials filed. There was I don't ever like to see a short seller of some renown go after a company, and then the next day the company put out a release saying that they can't get their financials together. They get their financials together, then this stock is a very cheap stock, but I've got to be sure. Let's go to James in Virginia. James.
Hey, Mr. Cramer. I'm a first-time caller, long-time listener of the show.
Excellent. Excellent. What's going on?
I own a small position in Jackson Financial, ticker symbol JXN. It pays a nice dividend, and I've doubled my investment over the past year. I was wondering, should I buy more, hold, or sell some and take the profit?
I don't understand a company that has a 1 PE. I have to do work on that. That does not sound like something I necessarily feel comfortable recommending without doing more work, but thank you. How about we go to Jonathan, my home state of Pennsylvania. Jonathan.
A huge thank you for all you do, Jim, and a big Bucks County booyah to ya.
Oh, my God. Well, you know how much I love Bucks County. I will be there in 2 weeks. How can I help?
Hey, man, look forward to seeing you.
Thank you.
Jim, I'm part of the investing club. I love how the club is open to ideas from members and how your staff and yourself provide us. You guys give us these fantastic educational pieces. So my request, if I could be so bold, is about whether I should be concerned when I'm looking at the operating cash flow and net cash flow of a company. For example, is there cause for concern with the operating cash flow of $1.23 billion versus net cash flow of negative $482 million of Leondell base cell?
Yeah, there is. I mean, I don't like that at all. But, it actually is a very well-run company. So I'd be more concerned if I didn't know management and didn't think the management was actually real good. But it's not a stock that I'm recommending. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, just do it. Lessons from this week's Change at Top Nike. Next.
After Nike CEO John Donahoe announced his retirement last night, the stock roared today, and for good reason. Donahoe never made sense as the CEO of a sneaker company, let alone the largest sneaker company in the world. But he was a longstanding board member of Nike, who I'm sure contributed a great deal in that role. Problem is, he was a consulting guy who made the switch to tech about 20 years ago, coming to Nike by way of ServiceNow, PayPal, eBay, and originally Bain & Company. You see, that's not the resume of someone who should be entrusted with one of our national icons, Nike. As we know from Shoe Dog, the terrific autobiography by Nike founder Phil Knight, you had to be a sneakerhead or an athlete who played, or both, in order to run this business. Donahoe seemed to be devoid of these characteristics. He's suave, but they would have been better off with someone modeled off the late, great Steve Prefontaine, the legendary distance runner who was the first athlete to sign with Nike way back in the early 70s. Here's something ironic. When Donahoe took over at ServiceNow, the cloud software firm, in 2017, outgoing CEO Frank Slootman raved about him. Quote, John's extensive track record of creating value, driving innovation, and scaling a large technology organization will be critical as we continue to move ServiceNow up the enterprise value chain, end quote. It's true, he was a great fit at that enterprise software company, but it turned out to be a bizarre, oddly truncated launching pad on Donahoe's way to the top job of Nike in January 2020. Donahoe from ServiceNow to Nike? But a few months later, COVID went on to swamp Nike's operations, making the company less beholden to mall-based retailers, like the 2,500 stores controlled by Foot Locker. Nike tended to view these stores, frankly, as too downscale. They were anxious to premiumize the brand. So why not go all in on direct consumer? Yes, digital direct sales with a tech guy who must know it, right? He came from ServiceNow. Unfortunately, Donahoe did it too well. When the pandemic ended, Nike had the finest direct-to-consumer technology around. But people didn't want it as much. Two problems. One, after we beat COVID, people returned to the mall in droves. Nike had gone all in on digital, though, so during that period, On Holding, Deckers, which is Hoka's, Adidas, even Vans took critical shelf space in these mall-based stores. You started seeing New Balance everywhere. At the same time, we started hearing that Nike's innovation pipeline, at one time the envy of the industry, was drying up. Donahoe was adopting old models, previous incarnations that had been successful, and somehow he actually seemed to be proud of that. To which I say, what was Nike thinking? How could they have squandered this great job on someone who understood how to improve corporate onboarding and IT ticketing, but not how to sell brand new inventive shoes and not just the recycled old ones? His skill sets had nothing to do with running Nike. Of course, that's the fault of the board, not of the man. I personally wouldn't have picked someone who was so willing to leave ServiceNow after only 3 years on the job. Bill McDermott replaced Donahoe over there and promptly took the stock from 240s to more than 930 today. Donahoe took over Nike and its stock proceeded to do nothing, with his tenure seeing no increase in the stock price. That's amazing when you remember that the S&P 500 is up over 80% during the same period. Near the end of his tenure, he finally made amends with Foot Locker and repaired a lot of the relationships he helped destroy. But it didn't work in time. Nike's rivals, they had caught up to it, and in many cases surpassed it. I think there's a real cautionary tale here. Luxman Narasimhan, late of Starbucks, had many of the characteristics of Donahoe. He was known as a management consultant, not a coffee person. Frankly, it would have been better to bring in a good hospitality executive or someone who could help draw a heart at the top of a cup of Joe, foam cappuccino. Again, the stock reflected that fact until he finally got ousted. Which is what really matters here. Memo to the boards of directors out there. There are grades in this business. The stock market gives them. Donahoe got a gentleman's C, but Nike deserved an A student. Now maybe they'll get one. My advice, go with what Starbucks did. Find the equivalent of a Brian Niccol, late of Chipotle. Someone steeped in food and marketing who knows how to make things fresh and loved by all. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.